All right. So welcome to our year-end tax strategy for real estate investors and business owners. And we're your hosts. I'm Josh Baldovino. I am one of Derek's clients. And this is Derek Fujikawa. He is the managing partner of Fujikawa and Associates. Derek, how are you doing today?
Good, thanks. How are you doing?
I'm good. So I also just clicked the go live on
Okay.
Instagram. So we're there. Go ahead and do
Okay.
that too. But today we are answering your tax questions live. So you can either ask them in the comments down below, or also we
hmm
got a whole bunch on social media that we need to respond to too. So we'll
hmm
take that. But as you trickle in, go ahead and put in the comments. I guess question for you, Derek, just kind of quick
hmm
context. As it comes to taxes for real estate investors and business owners, what's like the ideal cadence for you as you're talking to, let's just say, a real estate investor who's buying some rental properties? How often should you be
hmm
talking to them? When do you reach out? What's kind of that? What does that look like in terms of a strategy for you?
Yeah, I mean, just on a kind of an average year, say, quarterly is probably a good time to meet up. But, I know real estate investors don't work on a schedule, right? I mean, if a property comes up, it comes up, and you don't want to buy it. So really, whenever any major decision is going to be made, you want to talk to me first, or talk to your accountant first, and make sure that you're, doing the right thing in terms of record keeping and potential tax pitfalls or benefits.
Gotcha. Yeah, I mean, it is, especially if you're an investor. If the deal's there, the deal's there, and
Yep.
you're running
Yeah.
through
Yeah.
it.
Yeah. Yeah.
At the very end, my team did just close on an assisted living facility out in Fresno. So
Yeah. That's
as we get
great.
to the end, I want to ask all the things that I need to prep for you to make sure
Sure.
that we're on track. But let's go into all your funny questions that are happening in live. And so we're live on Instagram, Facebook,
hmm
YouTube, all that good stuff. But
hmm
I got one question here. This is from Mike. Let me go ahead and put this on a banner. Oh, it's too long to paste, but I'll add the first bit of it here. So this is from Mike, and he converted his garage into an ADU this year in Southern California. He now has a tenant living in it. He also
hmm
has a W-2 as a physical therapist. Will I be able to deduct all the money I spent to convert the garage into an ADU from my W-2?
So that one's a little tricky question. It's kind of a yes and no question.
Okay.
Um, if you converted your garage to an ADU, then that's essentially an improvement to the building. And so improvements need to be depreciated over time. So yes, you would be able to deduct it, but over time. So you wouldn't be able to take all those expenses and just take one big write-off in that first year where you made all the expenses. But so for residential properties, you can depreciate them over 27 and a half years. So all that money that you spent to improve the property, you would divide that up over 27 and a half years and take that over that lifetime.
So if I'm just doing quick math, this is super back of the napkin. If an ADU say
Yeah.
costs 300 grand to build
Mhm.
over 27 years,
A little over 10,000 a year that you'd be able to deduct against the rent income that you have on that property.
but that's the rental passive income, not the
Yes.
active W-2 income.
Yes, correct. Correct. Yes, yes.
Okay.
Against the rental income itself, only the rental income. So we can get as deep as you want into this, but yes, they have different different kind of buckets of income, and the rental income's passive income, your W-2 income's active income, and there are rules for both of them, and they when you have losses in one, they sometimes can't be commingled.
Okay. Fair. Now, we did the short-term rental loophole, which is
hmm
that's the favorite one on Instagram that everyone talks about. You have an
Yep.
active W-2 like me. You also manage and material participate on a short-term
hmm
rental, and you can offset those off the active income if a
Yes.
whole bunch of different qualifications are made.
Yes.
Assuming that you know those, what if your ADU was a short-term rental?
So if it was a short-term rental and you do qualify for that short-term rental loophole, less than 7 days average stay, and then material participation, which in general is 500 hours of material participation or 100 hours or more than anyone else. There are a few others, but those are the two main ones that people use. If you qualify there, then it actually becomes an active business,
Mm-hmm.
and that's where that loophole comes in. If it's an active business and it has a loss, then you can deduct that against your other active income, um, like your W-2 income or other business income. You could deduct that against that, which normally rental properties are by definition passive, unless you can meet
Mm-hmm.
that qualification of active. So passive uh, losses from passive activities can't offset your active income, your W-2 income, your business income.
Hmm.
But if you can meet that loophole and make it active, then you can now take those losses and apply them against your W-2 income.
That I never thought about it from an ADU perspective,
Hmm.
but that's like to build an ADU is like 300 grand,
Yeah, yeah, it can be. It can be pretty expensive.
and that's not even including furnishing it. So
Yeah, yeah.
okay,
So
that's
yeah, if you combine the whole cost segregation and everything, you can get quite a substantial deduction in that first year if you can qualify as an active business.
okay. Another personal question, just because I know
Sure.
that you built a office ADU in your backyard.
Hmm.
Did you? How does that work with your business and that ADU?
So my ADU in the back, it's a separate structure from our house. So I was able to kind of carve that out from our house, and the cost of that I'm using as a business property. So I'm depreciating that over as a business property. So it's a little bit longer, but it's um but I can deduct it against my business income. So business property or commercial property is 39 years versus 27 and a half years. So it will take me quite a while to depreciate
Mhm.
this whole shed, but I am whittling it down as the years go by.
Interesting. Yeah, I mean, I don't know if you know, we've been doing some consulting for an ADU builder here in the Bay Area,
Mhm.
and this whole extra tax, potential use of it could be helpful in terms of winning business. Okay.
Sure.
So again, if you have any questions for Derek, we got him, now before dinner time. So put them in the comments. I got one on my Instagram here from Kathy. And so
Mhm.
it's hello, I'm an RN, and we got a single family home and turned it into a duplex.
Hmm.
Let me put the banner on. Here we go.
Mhm.
60% of the rents are as a long-term rental, 40% in STR, less than 7 days rental. Can we do a cost seg on the 40% that's an STR?
Yes, the portion that's the STR, you should be able to do a cost seg on that piece, as long as you can show that that one side is, you know, has the 7 days or less,
Hmm.
and that you have that you have to hit that material participation too. So it's not just the days rented, but you have to materially participate. And again, like I said, it's either 500 hours or 100 hours, but more than anyone else. If you have a property manager or something like that, you probably wouldn't hit that one particular rule, the 100-hour rule. But if you're doing, all the cleaning and things like that, and you have over 100 hours and more than everyone else, then you could qualify as a material participating.
These are all fun, unique situations.
Yeah, yeah.
All right, I got another one coming in live. So
Mhm.
Juan asks, in regards to office space, if I'm using part of the garage as an office, can I and how do I write it off?
So in this instance, your garage is attached to your house. It's part of your house. So that would be kind of considered an office in the home situation where you would take the percentage of the space, the garage space versus your overall space in your house. And then you can depreciate, that percentage of your house. You could take that percentage of your utilities, insurance, maintenance, those types of things, anything that applies to the entire house, and use that percentage. So say that's 20 or say 200 square feet and you have a 2,000 square foot house, then 10% of um, all of your household expenses can be deducted against your business, as well as 10% of the house can be depreciated.
So it sounds like I got to do some calculating and then talk to Derek.
Yes. And there are some rules on that. So yeah, you do want to definitely, make sure um, that you follow those, because it's not necessarily a red flag, but it's just something that can be looked at, since you're deducting a personal expense on your business. So you just
Mhm.
have to make sure that everything is well documented.
Fair. Okay, we got one here from TikTok.
Hmm.
This was a pre-asked question. Adding to it, it says, "Why is real estate income given a tax haven with a Schedule E? With Schedule E doesn't require an LLC to deduct costs compared to hobby income." Do you understand this one? I
Um,
don't. And if we'll get back to
so
you, that's okay too.
yeah, I mean, I, I'm not quite sure what the the overall question is, but I can kind of go over a few things. So like, yes, real estate is kind of considered a tax haven because you can cash flow with real estate and not pay taxes on it because you have that depreciation, you have that paper loss that allows you to offset your rental income.
Mhm.
So even if you do have, say, a cash flowing property, um, oftentimes you're not going to have to pay taxes on it, at least immediately. I mean, you are going to in the long run, because as you're depreciating the property, you're reducing your basis in the property. So when you turn around and sell it, you will have a gain on that property. So um, that's kind of, that's why they're considered a tax haven, I guess. And a lot of people can use those to kind of earn income without having to pay taxes on it.
Mhm.
You don't have to have an LLC to have a business. Many people, I mean, a lot of my clients just own rental property and don't have it in an LLC. A lot of them do as well, but you don't have to have an LLC. A hobby is something totally separate. Hobby would be a business that you're engaged in, that you don't have a profit motive for. So that's something where, like, the classic one that the IRS goes after is like horse breeding. Like, people like to breed horses um, as a hobby, and they try and make it a business,
Mhm.
but they just deduct all their expenses because it's not profitable. It's not often
Yeah.
not very profitable. It can be, but it's often not very profitable. So but people love, like, horses, so they'll do that and try and pass it off as a business and just have these losses every year. If the IRS sees you don't have a profit motive, then they're going to come in and call it a hobby, and you get the worst of both worlds. You have to report all the income, and then you can deduct the expenses, but in as a miscellaneous itemized deduction, which are no longer deductible right now under the current tax law. If things stay the course, they'll come back in a couple of years. But even if you do fall under the miscellaneous, it's not a great situation to be deemed a hobby. So
Okay.
you really want to make sure that you have a profit motive for your business and not get classified as a hobby.
So if you are trading cards or
Yeah,
breeding some dogs, talk to
yeah.
Derek. Okay, you brought up something that sparked a question I'm sure that you get a lot,
Mhm.
which is when should you open a new LLC?
So an
What?
LLC is more like a liability protection.
Mhm.
So an LLC generally will not save you any in taxes. Uh, yeah, it's a vehicle to put your assets in that will help, um, give you some liability protection. It may have a few things you can do with it that may help you save a little bit in taxes, but in general, especially with a single member LLC,
Mhm.
like if you're just going to set up an LLC for yourself for your own property, it gets taxed the same way as if it was not in the LLC. It's going to be in a Schedule C. It's going to be on Schedule E. It's considered a disregarded entity. So there's really not much you can do with it differently than if you owned it outside of an LLC, or had the business or property outside of the LLC. It just provides you that liability protection. And if you're in California, you get to pay $800 for the privilege of doing business in California.
So if you're thinking about opening a new LLC,
Mhm,
that's definitely a question of, do I actually need one or not?
mhm. And oftentimes with multiple partners or multiple people in the business, then an LLC is a good idea because you can protect yourself from the
Mhm.
actions of other people within the business. But as a single member LLC, there's virtually, really not much difference, tax wise at least.
Okay, fair enough. All right, got one here from Jen Chu.
Mhm.
Planning to use the STR loophole when evaluating a cost seg service, what factors should I look for? Just the company that quotes me the largest depreciation or has the lowest fees?
um, that one, I would talk to other investors and
Mhm.
get experience with those. The lowest cost is maybe not necessarily going to get you the best result. They may give you the largest depreciation or whatever, but you want a reputable company, someone that's been doing it a long time, someone that has a track record, and just ask them, if their clients have been audited, what's their success rate when they get audited. And yeah, because it it is going to be a red flag on your return if you have a big deduction. So you have to be prepared for that and just make sure that you're, ready. It's not a bad thing to get audited in that. I mean, you can kind of not expect it, but it's not a surprise if you get audited on that because of the large deduction. So you just want to make sure that you have a reputable company that's done the cost segregation so that you have that backup when you have to show it to an IRS auditor.
Okay. Again, if you have any questions live, put them in the comments, put them in the chat. This one here is again from TikTok. Ooh, go for it, pest solutions. That's fun. Adding this one here. So any advice for someone who's starting a new business, maybe some kind of checklist that can help you keep track of what you need to keep track of. We've been talking about that, to make a checklist, right, for new businesses. Like, here's what you got to do by the month.
I don't have anything in particular. I guess I should probably put something together, but in general, it's mostly just making sure you're doing all the proper filings at the beginning, that when all the due dates are for filing. Certain entities have different due dates. So if you have a multiple member LLC, a partnership, or an S corporation, you have to file your tax return on March 15th, not April 15th. That's one of the big mistakes I see with some people, is everyone just assumes April 15th is a tax filing deadline. But if you have a pass-through entity like a partnership, S corporation, multiple member LLC, then you do have to file by March 15th. You can't extend it, but need to file that extension by March 15th. And yeah, just make sure that you have all of your state filings and local filings in order, and then getting a good bookkeeper if you don't like doing it yourself, and having all of your books in order, and making your accountant's life a little easier come tax time.
I promise we're gonna work through this together, Derek. I know mine's messy.
Not naming any names.
Okay, so this one is from Eric Does. Going back to some real estate, what about security dogs to stay at your vacant properties? Can that be used as a business expense?
So business expense is defined as ordinary and necessary. So if you can show that you've had security issues and you need these dogs and they're actually, serving a business purpose and not just your pet that you take to the business every once in a while, then yes, I would say you could deduct it. But again, you need to document it and make sure, because you have to prove that the burden of proof is on you to show that it's an ordinary and necessary business expense.
Okay. Love it. Love it. Going back, there's one here in terms about do you prepare taxes and provide strategy for those living outside of California?
Yes, yeah, we definitely have quite a few clients outside of California, so it's not an issue if you're not here local.
How does that work? Are there any? I mean, obviously, I have investments outside. How does that work on your end? Is that really difficult as you go across different states now too?
I mean, software's made it much easier, but yes, I mean, we do have to be familiar with filing requirements and things like that with other states. So I just have to keep up with it. And in general, I'll figure, I'll learn about it once if I get a client from another state, or a client moves to another state or buys a business or rental property in another state, then I do my research on that state and find out what the filing requirements are and what needs to be done. But the software also takes care of quite a bit of that.
Okay. How about international investments?
That one kind of on a case-by-case basis. I do have clients that have international rental properties and things like that, but that's kind of a case-by-case basis. Kind of depends on where it is and what's involved, and if it gets a little too complex, then I would refer to a more local person in that area.
Okay. How about this one? This is more of a personal finance question, but this one comes from Ian Cruz, and so it says, "What about a full solo 401k? You have any recommendations for providers?"
That would be probably something more for a phone call, but solo 401ks are a great tool for small businesses, because it does allow you to put potentially more away than, say, a SEP IRA, because you can do the deferral, and then the company can match it. So there's some different things that you can use where you can take more than just the set percentage of, say, a SEP IRA. So it is a great tool. It is a little more work because as it gets larger, you do have to do additional filings. It would have to file a benefit plan tax return once it gets over. I don't remember. I don't do too many of them, so I think it's like over 250,000 or something like that. But if you're maxing it out every year, it can get pretty big pretty quickly.
Okay, fair enough. Well, then Ian, go give him a call. This one's always fun, and I feel like kind of interesting. Do you pay taxes on casino winnings?
Yes. So the IRS rule is yes, you have to pay on all winnings. So if you won $10 at a slot machine, you're supposed to report that. Now you only get a W-2G if you win more $1,200 or more. So they don't know how much you win, if it's under $1,200. But technically, you're supposed to report all your gambling winnings. You can deduct your losses against those winnings, but technically, you're supposed to. Now, does everybody? No, but unless you get that $1,200 or more W-2G. But technically, the law states that you're supposed to report all your gambling winnings.
Well, on that same notion, I think there's a follow-up question. I wonder if I can win $1,199, so $1 under the limit, cash out, go back, and keep repeating the same process with no forms.
Yeah, I mean, if you're lucky enough to keep doing that, keep winning. I guess you could. If you deposit that money into your bank and you get audited, they're going to ask for bank statements, and then if they see a whole bunch of $1,199 deposits over and over again, they're going to ask where this money comes from, and you're going to have to show where it came from, and you could get hit with tax evasion at that point. But yeah, I mean, if you're never audited and you try that, I guess you could get away with it, but I wouldn't recommend it. It's funny, like in the casinos, I remember I used to see jackpots would max out at $11.99 like on something, so that they wouldn't have to give you a W-2G. I don't know if they, I haven't seen that in a while, but I remember seeing some of those where they wouldn't go beyond $1,200.
I wonder what the payments, or like if that increased people playing those games just because of that.
It might, yeah. Yeah.
The people who really, really know.
Yeah.
At that point, you should probably not go to the casino. Okay. So let's go into my situation. So we just closed.
Sure.
So our LLC, our partnership, Invest Capital, just closed and co-GP'd on assisted living in Fresno.
Mm-hmm.
What should I be sending you? What do you need from me and to prepare so that our tax time is easier?
Mm-hmm. So the biggest thing is, so the purchase contract. So did you purchase just the property or the actual business itself as well?
Both.
Or both. Okay, yeah. So the purchase contract for the property as well as for the business if they're separate.
Okay.
And then just basically all the business documents. If you set up a new corporation or a new LLC, you need all the incorporation documents, information for all the owners and everything.
Okay.
And then,
so if it's our existing LLC that's partnering with their LLC, do I need to send that info too, or is it really just the K1 that gets bit back to us after it's all said?
Yeah, so I guess it depends. Whoever's doing the tax return for the overall business would need both LLC information, because I guess those would be the two partners in the business. And so you wouldn't need each individual within those LLCs. You just need the LLC information. And then they would get a K1 from this overarching business. And then that K1 would go to, say, your LLC. And then your LLC will distribute that to the partners within, or the members within your LLC. So really at the end of the year, I would just need the K1 from that overall business to go, that goes to the LLC.
All right. And then just to paint the full picture, we also got a portion of the acquisition fee. So we'll have a little bit of income.
Okay.
How is that calculated? How does that affect us?
So that will just be straight income. So then any expenses you incurred while consummating the transaction would be deductible against that income. So,
Okay.
Just
No
track
wrong
that in
time.
your books, and then that'll offset the income, or offset some of the income.
Yeah. Okay. Sweet. That's it for that one. Obviously, I gotta send you some docs on that now.
Yeah.
Okay, so we have Fan of Airplanes asked, how about crypto? Any
Mhm.
nuances with tax-wise and cryptocurrency?
There's a couple of things. I mean, there's a question on the return that you have to answer. So if you do have any crypto transactions, there's a question on there that you have to answer yes to if you bought or sold any crypto during the year.
Okay.
That's one thing that some people kind of miss. Software's pretty good about catching that or asking that question, but that's one thing. And then crypto is just like any other capital asset. So when you buy it, you don't have to report anything as far as the purchase. But when you sell it, that's when you report your gain or loss on that particular coin. So you do have to kind of track it. It can be kind of messy because I know people can buy like down to the what point, like 20 decimal places beyond the decimal point. So, it gets a little hard to track, but usually good software will help you kind of keep track of that and kind of match things up. Um, but yes, you do have to track it. It's just like purchasing stock. And now, like places like Coinbase and other um, wallet places will send you a 1099 at the end of the year with your
Mhm.
gains and losses. But some of the overseas ones or the smaller ones may not send a 1099, but you are still responsible for reporting the sales.
Okay, so there's no fun extra benefits to crypto, right? There's no extra loopholes or hacks.
Not necessarily. I mean, yeah, it's just your gain or
Normal.
loss based on what you bought it for and what you sell it for.
I mean, and I guess the hard part is, and this is more like a philosophical government question now, is a lot of
Mhm,
the real estate tax hacks they're really just incentives by the government to say, hey, invest here.
mhm,
And there's no public thing yet for the government to say, yes, we're switching all this currency into crypto now.
mhm.
So there's
Yeah, I
no
mean,
there's no incentive that they're pushing.
no, not at this point. I mean, there could be in the future, but not currently.
How about it's election,
Mhm.
end of the year, change to 2025? That you have on the radar that is like penciling on the docket? Anything that investors or business owners should be aware of?
Yeah, I mean, election years are usually, in terms of from a tax perspective, are usually really quiet because no one wants to introduce anything sweeping or changing. During an election year, they don't want to ruffle any feathers or cause anyone to be upset and not
Hmm.
vote for them, right? So generally, election years are relatively quiet years from a tax perspective, and this year hasn't been much different. Now, not to say that things can't change after the election and something gets passed, right at the end of the year. Um, the worst is when a new tax law gets passed, say in January or February, and and it's retroactive to the beginning of the previous year, then things become a mess. And it was a couple years ago where we thought that was going to happen, but it didn't. But yeah, so not a whole lot on the horizon. There is the Tax Cuts and Jobs Act is set to expire at the end of 25, I
Okay.
believe. So all those, the $10,000 limit on state and local income taxes, the limit on mortgage interest down to 750, a lot of those things that are in that law are set to expire. So they could be extended by Congress. Depends on who's in office at the time and
Hmm.
what the economy and the environment is like at the time. Either candidate could extend some or all of the provisions in there. So it just depends on you know what it's like at the time. So hard to say, but we just kind of assume that they're going to expire as of now, and then if they don't, they don't, and we pivot from there.
Okay. So no crazy change. There is one beneficial owner reporting that you have to do. We'll touch that
Yes.
later. We got a question live, so I want to hit that first. So Juan, again, my spouse and I own a duplex, work a full-time job, and I'm also a real estate agent. My wife is a full-time mom and does property management for the duplex. She does not have earnings from the property management, but have spent money, repairs, and maintenance. This would be our first time doing taxes as owners of a rental income property. There's a question of what is the advice on that? I mean, I guess, Quan, be more specific with the question. And then, or is there a certain ask you have? I guess my question is, Juan's a W-2, is the agent, but the wife also does property management for the duplex. What is the take on her being able to get the real estate professional status?
Yeah, I was just going to say, this is kind of the classic situation where you could possibly take the real estate professional route. So with a full-time W-2 job, it's hard to qualify anyone that has a full-time job as a because you have to have at least 750 hours in the real estate business, and that has to be more than your other income producing activities. So if you have a W-2 job that's not in real estate and you're working 2,000 hours, you have to have 2,001 hours in real estate. And that means either you're not sleeping or you're doing nothing other than working in real estate, right? Which is highly unlikely. But if your spouse does not work, then she may qualify. If she can get that 750 hours and if she's not working, that would be more than, other income producing activities. And then she could qualify as a real estate professional, which then all that rental income relating to that would become active income or potentially active losses. And you can deduct that against, the spouse's W-2 income. So this is one of those situations where that could work. Now, again, to be a real estate professional, you have to be very diligent in your record keeping and make sure that you track all of your hours. So if you haven't been doing it now, either go back and, make sure that you document everything up to now and through the end of the year. And, you have to have that 750 hours in the real estate business, and also have 500 hours of material participation in the property that you have. So just that 750 hours is not, enough if it's not, if it's not directly relating to your potential, your property as well.
Okay. Yeah, I mean, I saw that and I was like, oh yeah, that could be a good play. So Juan, definitely if you have any other questions, make sure to reach out to Derek. Going back to the end of the year things, this is, if anyone wants to do anything tax-wise, you have 2 months.
Yes.
To put it
almost
in play.
Exactly. Yeah.
Otherwise, when it comes tax filing time, too late. Sorry for you.
Yeah, there's a couple of things you can do, but not much you can do after January 1 passes that will affect your 2024 tax return.
So any changes you make, whether it be property acquisitions or large capital improvements to business or equipment purchases, I guess if you are worried about having a significant amount of income and want to figure out what you can do, there's 2 months to then talk to Derek or your CPA. Friendly reminder. Otherwise, it's too late.
Yep.
What about charitable giving? How does that get into the mix? Obviously, a lot of charity galas and event. We're hosting one in 2 weeks. How does that go into the mix in terms of someone's taxes?
Yeah. So charity. So gifts to charity are an itemized deduction. So you can deduct it if you itemize. So the standard deduction is roughly about $30,000 for a married couple, $15,000 for a single individual. So if you're taking the standard deduction, then giving to charity may not benefit you because, unless you're giving so much that that and your other smaller deductions exceed the standard deduction, then giving to charity may not give you a tax benefit. But if you are itemizing, then those just add to your total itemized deductions and give you a benefit. I tell my clients, give to charity for charitable reasons. Don't give to charity for tax purposes because at most you're going to save 50%, right? So you're going to give away $1 to save 50 cents in taxes. You're still out the dollar. You're going to get 50 cents of it back, but so now you're out 50 cents from where you were before you gave that donation. So if you're solely doing it for the tax benefit, you're actually worse off at the end of the year. But but if you want to donate to your church, to your to an organization to help them out, then
Mhm.
yes, the added benefit is you could get a tax deduction for it.
Okay. Okay. So give with heart, not with tax
Yes. Yeah,
in
yeah,
mind.
yeah.
Okay, and then going back to the more end of the year, so the
Mhm.
it's beneficial owner reporting, right? Is that what it's called?
Beneficial ownership interest reporting.
Okay, I
Yeah,
missed an extra.
BOI for short. Yeah.
What is
So
that?
so small businesses, the IRS, not the IRS, actually it's a financial crimes reporting. I forgot what it stands for, but
Which, hold on, by the way, the website kind of looks like a scam website. So whoever was on the marketing team for that,
yeah, it's FinCEN. FINCEN is the organization that is requiring or government organization that is requiring this. It's the same one that requires you to report your foreign assets. If you have $10,000 or more in foreign assets, then you're supposed to report that to them every year. But this beneficial ownership interest report is required for all small businesses, and it's for small businesses. So large corporations don't have to do it, but small businesses do. So any type of entity that has to register with the state. So an LLC, S corporation, C corporation, limited partnership, those all have to file this beneficial ownership interest report. If you're a partnership or a Schedule C, you don't need to do it. Or a sole proprietorship, I should say. And single member LLC has to file a Schedule C also, but a single member LLC does register with the state, so they would need to file the beneficial owner, the BOI report for short. And so you basically have to report anyone that has a beneficial ownership interest in the business. So in general, that's the owners, but we're in California. California is a community property state, so your spouse owns an equal, undivided interest in your assets, unless you had a prenup and you had this business before you got married. But if you started it before you got after you got married, or if you don't have a prenup, then they do have a beneficial interest in the business. So you need to report yourself as the owner, your spouse as the beneficial owner, any partners, um, and then anyone that has significant influence on the business as well is a
Hmm.
beneficial owner. So even if you have say a manager for your business that can influence everything but doesn't own anything, they could be considered a beneficial owner. So I would go to the FinCEN website and look at their FAQs and see if anyone in your business could qualify as a beneficial owner.
And we'll leave that link down below to add it
Yes.
in post to have that real website in there.
Yes.
And actually, that's the learning point for me, because I know that you actually asked me for my wife and I's driver's license. I haven't
Mhm.
sent it to you yet.
Yeah.
I actually did. I did a portion, some of the LLCs
Mhm.
already earlier in the year, because they
Okay.
were like, "Oh, you have to do it fast," and I was like,
Yeah.
"Oh no." But I didn't also realize that I had to report my spouse on those.
Yes. So if you didn't,
So
you'll
now I
want
had to
to
do
amend it
some
and
edits.
add them in. Yes. Yeah.
Okay.
So, yeah, and the rule is it has to be filed within 90 days of your business being formed or your registration with the state. Or since this is brand new, if you were in existence prior to January 1 of 24, the beginning of this year, then you have until the end of this year. You have until January 1 of 25 to file the report.
Okay.
So most businesses, all businesses that were already in existence when they started this, have until the end of this year to file it.
All right.
But if you're starting a new business, you have 90 days. So you need to make sure that you get that in within 90 days if you start a new business.
Okay. Fair enough.
Mhm.
So I think that's all the questions we got. Derek, any last tax advice or keys before the year ends that you want to
Yeah,
tell
well, I
some
mean,
people?
just like something you mentioned, right? Just we have 2 months. If you want to take a look at things and make any changes to your return, or not return, but changes to your current situation, you have 2 months to do that. So, once the ball comes down on New Year's Day, it's a new year. You can't do a whole lot for 2024. So really, if you want to do some tax planning, now is the best time. And now's a good time to get your books caught up. Make sure, if you have a business, get those caught up so that you can see where you are. And, like I said, make any changes before the year ends.
Yeah. And again, if you found this helpful, please make sure to subscribe both to wherever you listen to it, because we're streaming this everywhere. So you can subscribe to Derek's channel, to my channel. Our usernames are right here on the screen on Instagram as well.
There.
And then if you want to go ahead and if you have any other questions, Derek does do initial consultations. So that should be already linked down in the description below as well. So if you want to book one of those calls, definitely do that. And then, of course, the last thing is share this. If you have any of this information helpful, share this with your business partners, your spouses, whoever you know that's doing some business work or real estate work. And hopefully you can share a little bit of value with them. But Derek, I appreciate you. I learned a lot today, and we've done a lot of episodes, and I feel like I got a lot of my questions answered. So thank you.
No, thank you.
And for the rest of you guys, go ahead and binge watch the rest of Derek's videos there. You can search if you're opening real estate, if you have long-term rentals, multifamily, syndications, all up there. Just search through his channel. And some of those even also have real case studies of my own properties, and we just break it all down. So if you're curious to see what those look like, you can go ahead and search on his channel. And for the rest of you guys, I will see you guys on the next video.
Great. Thank you.